Navitas Semiconductor stock is trading at exactly $26.18 per share right now, plunging by a sharp 14.64% during today's intraday trading session. If you have been tracking this ticker closely, this dramatic drop might look like a sudden emergency, but the reality unfolding behind the scenes is far more calculated. While mainstream retail traders are panicking over a massive single-day decline, institutional block orders are quietly shifting, and a specific regulatory filing that hit the desks last night explains exactly why the stock is behaving this way. This extreme volatility is the cost of admission for one of the most aggressive high-beta tech plays of the year, which had just hit an all-time high of $34.17 earlier in the week. The sudden drop today is driven by an SEC Form 8K filing showing that Navitas issued over 3.2 million new shares of Class A common stock to settle contingent obligations from its previous business combination agreement. This brings the total issued under the agreement to over 6.5 million shares, with a looming overhang of up to 10 million total shares if specific price targets are hit before October. This dilution is hitting the market at a highly sensitive time, acting as a perfect excuse for big money to lock in profits after the stock surged more than 335% since the beginning of January. Navitas has been skyrocketing due to its high-profile partnership with the NVIDIA stock ecosystem, showcasing an advanced 800-volt power delivery board at the Computex event in Taipei. The popular expectation surrounding Navitas was that its integration into next-generation artificial intelligence server architectures would provide an uninterrupted upward trajectory for the stock price. Investors looking for a high-conviction pure play on advanced materials assumed that the stamp of approval from elite silicon designers meant the small-cap stock would ignore broader macro headwinds. The reality, however, is that while the technological validation is solid, the near-term commercial volume remains highly speculative, and the financial structure is heavily burdened by share dilution and a persistent net loss. Morgan Stanley recently highlighted this gap between enthusiasm and numbers, maintaining an underweight rating and a $13.70 price target, citing limited immediate visibility for the 800-volt architecture. When you look at modern online investing, individual investors often get trapped in the excitement of a massive tech narrative without checking the structural mechanics of the individual brokerage account data. Platforms like Robinhood have democratized access to these hyper-growth names, allowing users to buy fractional shares and chase massive momentum waves. Yet the traders who bought in at the $34 peak are learning a hard lesson about momentum stocks during a broader market retreat, as the Nasdaq itself dropped 2% today. This risk-off environment disproportionately punishes companies with high price-to-sales multiples that are not currently profitable on a GAAP basis. The trading volume today has completely eclipsed historical daily averages, proving that a major battle is taking place between retail liquidations and institutional accumulation. Many self-investing accounts utilizing automated tools or a robo-advisor are hitting stop losses, which accelerates the downward pressure in the morning blocks. On the other side of the trade, sophisticated wealth management desks and active trading systems on platforms like Interactive Brokers are evaluating whether this double-digit haircut represents a structural breakdown or a classic buy-the-dip opportunity for long-term positioning. Navitas operates in a highly specialized sector, focusing entirely on gallium nitride and silicon carbide technologies, which are advanced materials designed to replace traditional silicon in power management. These wide bandgap semiconductors allow electronic systems to handle higher voltages, run much cooler, and switch at frequencies up to 100 times faster than old-school silicon chips. The business model previously relied heavily on mobile phone fast chargers and consumer electronics, but management executed a sharp strategic pivot toward high-power enterprise markets. They are explicitly targeting AI data centers, renewable energy grids, and industrial electrification, aiming for a massive expansion in their total addressable market by the end of the decade. The financial results for the first quarter showed a sequential revenue increase to $8.6 million, beating the consensus estimate of $8.22 million, which was largely driven by a 35% year-over-year jump in their high-power segments. The non-GAAP earnings per share came in as a loss of $0.04, outperforming expectations, while their specialized infrastructure division expanded by 50% quarter-over-quarter. Despite these positive indicators, the absolute revenue figures show that the company is still in its very early stages of commercial scaling, making its multi-billion-dollar valuation highly dependent on aggressive future growth. Comment below how many shares of Navitas Semiconductor you currently hold, or if you are planning to avoid this volatility altogether. Looking closely at institutional positioning, major asset management firms like BlackRock and Vanguard hold substantial stakes in Navitas, which provides a layer of institutional support but also increases vulnerability to passive index rebalancing. When broader tech exchanged funds experience outflows, these smaller, high-beta components are often sold indiscriminately to meet redemption demands, regardless of their individual corporate developments. This technical selling pressure, compounding with the recent share dilution, creates a volatile mix that can easily push a stock far below its intrinsic value during a market correction.
The ultimate test for Navitas will be how quickly its partnership with major enterprise platforms translates into material purchase orders that can absorb its ongoing operational cash burn. The expectation built into the recent all-time high was that every single AI server rack deployed next year would require their proprietary 800-volt power boards to maximize energy efficiency. The reality is that enterprise hardware cycles move deliberately, requiring extensive qualification phases, competitive bidding, and complex supply chain integrations that can take many quarters to materialize as actual top-line revenue. For an investor managing an active portfolio through modern digital platforms, whether you use online investing portals, traditional fidelity brokerage accounts, or advanced automated tools, understanding this friction between story and execution is vital. The narrative surrounding advanced power semiconductors is compelling because data centers are facing severe electrical grid constraints, and improving power density is a fundamental physical necessity. However, a great technology does not automatically protect a stock from short-term financial dilution or sudden valuation corrections when the broader macro environment turns hostile. To summarize the core dynamics at play, Navitas is currently experiencing a severe reality check as corporate share dilution collide with a broader market sell-off, pulling the price down to $26.18. The expectation of a frictionless rise fueled by high-profile tech collaborations has run directly into the practical realities of a small-cap firm navigating early commercial scaling and structural supply expansions. While the underlying technological validation remains a major long-term asset, the near-term technical setup suggests that the stock will remain highly volatile as the market digests the newly issued shares and looks for concrete evidence of enterprise revenue. Managing this investment requires looking past the daily percentage swings and focusing entirely on structural profit margins and contract execution over the coming quarters.